Hello, my name is Nanette Abuhoff Jacobson at Wellington Management, and I'm delighted to be joined by Danny Cook. We are both strategists in the multi-asset team, and we're happy to be able to share with you our 2022 outlook. Can central banks nail the landing? We'll spend about 15 minutes going through our key views and recommendations. Let me kick off with our asset allocation views and recommendations. And let me say at the outset that we are monitoring the Omicron variant. This is obviously something in real time that we're getting new information on and still waiting for data on the virulence and transmission. Now, given that there are a lot of unknowns still, our base case is that even if Omicron slows activity, it will be short-lived. And the fact that we have a higher vaccination rate globally, that will help preventing full lockdowns in most economies. Now, the one thing that it won't change is the fact that we are facing inflation pressures on the supply side, both in labor and commodities. And we don't see that changing even with the variant. In fact, it could exacerbate some of those pressures. Okay, back to our asset allocation views. And we see a snapshot of where we are overweight and underweight. Let me start with our bottom line, which is we do see the economic recovery continuing into 2022. We think it's supported by a healthy consumer and a healthy business environment, given all the liquidity in the system. The rub is that we are facing an environment where central banks are going to be tightening, so less policy stimulus there and less fiscal stimulus amid an environment where we do see sticky inflation. Okay, so overall, given our economic view, we do think that global equities should be overweighted relative to fixed income. We're only at a moderate overweight because we do see this trickier environment in 2022. Within equities, we prefer developed market equities over emerging markets equities. Emerging markets are dominated by China, and China is slowing down right now. And because of the property market where there's a ton of deleveraging, and also there's zero COVID policy, which could make exit from the pandemic more difficult. We also, within developed markets, actually like Japan. This is a non-consensus view, and valuations here are still considerably lower than in equity markets. In defensive fixed income, and within that we include high quality corporate bonds. Most central banks are tightening, and so it doesn't make sense to us to be overweight duration in any of these regions. The one region that's an exception, though, is Japanese rates, where the Bank of Japan is really not reeling back its yield curve control policy. So we don't see a case for higher rates there. We are also underweight investment grade corporates because spreads are quite tight there, and it is a long duration asset. Now, moving to growth fixed income, we have a neutral weight there. We do see pockets of value in growth fixed income. Our main allocation is to overweight EMD spreads relative to high yield spreads. The rationale for that is a valuation one. Emerging market debt spreads are quite attractive relative to high yield spreads, and we're more confident that credit spreads will mean revert in the credit markets than in the equity markets. And then finally, we do see pockets of value in floating rate credit, certainly like bank loans, more than we like high yield, and even in securitized, we like structured products that offer a floating rate structure like CLOs. The final view that we have and feel most strongly about is our bullish view on commodities. This is a direct result of our view that inflation will stay high in 2022 for structural reasons. Even if demand does go down because of the Omicron variant or whatever else, the supply related issues, particularly in the labor markets and the commodity markets, where we're seeing a combination of shortages in inventories and strong demand. This makes commodities the best way to directly express a bullish view and our strong view on inflation. So I will stop there and turn it over to Danny. Danny, could you take us through some of the fundamentals that are most important to you and also where you see the best equity opportunities?
Absolutely. Thank you, Nanette. So let's get straight to what's going to be impacting fundamentals and also what's really top of mind for a lot of investors right now. And that is COVID and specifically the Omicron variant. So we've shown this chart before. It shows the total number of people in the world who are not vaccinated against COVID. And that number is over 4 billion. So clearly plenty of opportunity for the virus to mutate. And it's really not terribly surprising that a new variant has popped up and is likely to become dominant. However, we are still optimistic on consumers, especially in developed markets, given how high vaccination rates generally are, and especially once warmer weather hits. And again, we have a 12-month view, and so we do think that consumers are still really well placed. Consumer savings is very high, and also our leading indicators point to rising wages that we think will at least keep pace with rising inflation. And so we are pretty bullish on consumers and on the services side more broadly. So on the next page, we have a pretty positive view of the global economy. As, like I said, we do think consumers and the services side post Omicron look really well supported. The flip side is inflation, which is a major risk. And one of the reasons that we're only marginally bullish, I would say, for 2022. So the chart shows just how high global inflation is. Now, the good news is that we do think we're quite near the top already, and this should slowly drift lower some as we progress throughout next year. For consumers, the good news is that wages have been rising even faster, and so we are optimistic on the consumer front. Now, in terms of regional allocations, Nanette, since you asked me about that as well, I think that this favors countries like Japan that have suffered from deflation for many years. So higher global inflation is a benefit to a place like Japan, whereas to a country like the US or many EM countries, which already suffer from too high inflation, I think that this could be a headwind. Okay, so I mentioned vaccination progress previously. This slide breaks it down by country. And generally, vaccination progress has been strong. But now what's clear is that the US is a laggard amongst its developed market peers. And so we think this is a solid fundamental reason to be overweight ex-US generally. And again, here we'll note that Japan is kind of at the top of this leaderboard, and we think is a place that's pretty well placed for 2022. So on the next page, one of the bullish arguments we like also about Japan is that despite higher consumer inflation expectations, which I would note is inverted on this page in lighter blue, we're still seeing higher consumer confidence, which has generally not been the case in the past. So usually higher inflation expectations has implied lower real wages. But this data we think is a clue that the labor market is really strong in Japan and that wages could keep pace. And so it's one of the reasons that we recommend people be overweight Japanese equities. So Nanette, I covered a lot of developed market information. I'm curious as to how you're weighing the pros and cons of EM relative to DM.
Right. And let's just be clear, we're talking about emerging market equities versus developed market equities. And it's a tough call because emerging market equities have really underperformed developed market equities this year. So valuations, in some sense, are incorporating the risks that we've seen. But our view is that these risks are going to persist. So, first off, I mentioned China is the largest country allocation to emerging markets equities. We are still in a deleveraging state, particularly in the property market. And the property market represents about a quarter of the total Chinese GDP. So obviously a huge force in the Chinese economy. If it's slowing, the Chinese economy will be slowing. And that really doesn't bode too well for the emerging markets index. Now, outside of China, we've got other things going on. First of all, in China and other parts of Asia, there really is a zero tolerance COVID policy, which means it's going to be hard for these regions to come out of the pandemic if they have to lock down parts of their economies when a case appears. So that's another problem, I should have said earlier, for China and some other emerging Asian countries. Now, moving outside of China, we're really dealing with a difficult post-pandemic situation for other EM countries. They're dealing with weak growth, high inflation, central banks are hiking rates. Most of these regions are dealing with poor fiscal dynamics because governments have had to spend a ton of money to support the economies. And of course, as you discussed, Danny, vaccination rates in emerging economies are among the lowest in the world. So eventually there will be a recovery, but our view is that the challenges in emerging markets equities are going to persist.
That makes a lot of sense, Nanette. So I know you mentioned credit in the beginning in your introductory comments. Do you want to take a minute to elaborate on what your views on credit are?
Sure. So in credit, as I said, not a table pounding view. We are neutral overall. And the key offsets are simply that spreads are pretty tight across the board. They did widen recently, but they're still, around the 20th percentile in terms of hit relative to history. So not a lot of opportunity from a valuation perspective. However, the thing about the credit markets is that the fundamentals are quite good. So when I look at the default cycle, we're at around 1.5% defaults. This is way lower than the long-term average of defaults, which is 4%. And we don't see much risk of that rising very much, unless, of course, the economy is derailed and we are looking at a recession. But that's certainly not our base case. So defaults are running low. They're not expected to rise much. And so that backdrop really justifies spreads staying where they are, not widening, not tightening very much because they are tight already, but staying where they are. So there's a good case still for some carry in the credit markets. As I said earlier, where we feel strongest is that EMD spreads, despite the fundamental backdrop, which is challenging, we do think those reflect the risks in the credit markets. And of course, the country composition is weighted away from China and in other regions. And we see high yield as vulnerable because spreads are as tight as are quite tight right now. In the fixed income world, in terms of high quality rates, we do see central banks tightening. So not a great environment to be long duration in government bond markets. So we are moderately underweight the US, Europe, and the only place where we are neutral is Japan. And that's because that is one of the few central banks that looks like it's not going to tighten, and they will maintain yield curve control, which means capping the 10-year point of the Japanese yield curve.
Thanks very much for that, Nanette. So as we all turn toward 2022, what are your concluding thoughts for investors?
Well, to summarize, I think 2022 will be a year of transition from COVID concerns to the state of the economy, inflation, and how central banks will respond. So a tricky mix, but I do think that the global recovery will continue, and that does support a slight overweight to global equities relative to bonds. I think that within equities, the one area that really hasn't been embraced by the markets is Japan, and we've got good reasons for why Japanese equities could really make its mark in 2022. Inflation will still be an issue in 2022. So we do think portfolios should have some exposure both to commodities or commodity-related equities. Also, other positions could be in real assets as well as inflation-linked bonds. And on high-quality fixed income, not the time to be overweight there, given the central bank backdrop of tightening. So slight underweight there. Really, you want to put your exposure still in risk assets, but those should be tempered given the central bank backdrop and the inflation backdrop. So that's it for our outlook. Danny, I want to thank you for your contributions, and thank you everyone for listening.